Central banks worldwide do not attempt to stop inflation entirely. Instead, they aggressively defend a specific 2% target. Why do economists target a steady 2% inflation rate? Category Macro. 0% inflation risks triggering deflation, a dangerous state where consumers halt spending because they expect prices to drop further. Inflation above 4% erodes consumer purchasing power too rapidly, destabilizing corporate planning and consumer cost of living. A 2% inflation rate acts as economic grease, encouraging consumer spending today while maintaining predictable price stability long-term. Follow Educo Global for more hidden macroeconomic secrets. Institutional investors do not guess the appropriate return for an investment. They use a mathematical formula to isolate risk. What is the CAPM model, and how does it calculate the expected return of an asset? Category: Finance. CAPM calculates a stock's required return based on the formula. Expected return equals risk-free rate plus beta multiplied by market risk premium. The risk-free rate is typically derived from government bond yields, representing zero-risk investing. The formula multiplies the asset's specific volatility score, or beta, by the broad market's expected premium to establish a fair reward profile. Save this short to master institutional corporate finance formulas. A minor drop in the stock market is considered a healthy correction, but crossing a specific percentage triggers an official market crisis. Why does a 20% decline define a formal bear market? Category: Markets. Market drops between 5% and 10% occur frequently and are standard volatility adjustments within a long-term economic expansion. A 20% drop from recent market highs marks a critical psychological tipping point where institutional investor optimism shifts entirely to fear. Crossing the 20% threshold historically signals deeper economic trouble, often aligning with or preceding a broader macroeconomic recession. Check current market indicators and follow for live cycle updates. Credit scores aren't just for individuals. Multi-billion-dollar corporations and entire sovereign governments are continuously graded on their debt. What is a credit rating, and how does it affect sovereign borrowing costs? Category: Banking. A credit rating is an independent evaluation of a borrower's creditworthiness, specifically their ability to make interest payments on time without defaulting. Specialized agencies assign alphabetical grades, where AAA represents the absolute safest investments and D represents active default or junk status. A lower credit rating increases a country's risk profile, forcing them to pay significantly higher interest rates to attract global bond investors. Look up your country's current credit rating and drop a comment below. The transition from a private startup to a publicly traded corporation on a global stock exchange happens through one monumental event. What is an IPO, and why do private companies choose to undergo this process? Category: Investing. An initial public offering, or IPO, is the process where a private company sells new or existing shares to the general public for the first time. The primary objective is to raise massive capital to fund corporate expansion, research, or pay off existing corporate debt. It offers early investors, founders, and venture capitalists an opportunity to liquidate their shares and realize profits. Subscribe to Educo Global for daily financial terms made simple. When a central bank drops interest rates to zero to revive the economy, but consumers still refuse to spend money, they enter a severe economic trap. What is a liquidity trap, and how does it neutralize monetary policy? Category: Macro. A liquidity trap occurs when a country's interest rates are exceptionally low or near 0%, yet consumers and businesses choose to hoard cash instead of spending or investing it. Because the public fears an upcoming recession or deflationary cycle, traditional central bank interest rate cuts fail to stimulate borrowing demand. In this scenario, injections of cash into the banking system fail to circulate, rendering standard monetary policy completely ineffective. Save this short to understand advanced central banking limitations. True financial literacy begins when you look past how luxury items appear and focus strictly on where they move your money. What is the technical difference between an asset and a liability? Category: Finance. An asset is any economic resource that possesses measurable value and puts physical money into your pocket over time, such as rental properties, dividend stocks, or an active business. A liability is any financial obligation that incurs ongoing costs and takes physical money out of your pocket over time, such as car loans, personal debts, or credit card balances. Building personal wealth relies on systematically acquiring income-generating assets while strictly limiting accumulating liabilities. Look at your recent purchases. Are you collecting assets or liabilities? Comment below. You do not need a complex scientific calculator or financial spreadsheet to determine exactly when your investment capital will double. What is the rule of 72 and how do you apply it to compound returns? Category: Markets. The rule of 72 is a quick mental math shortcut used to estimate the exact number of years required for an investment to double at a fixed annual rate of return. To use it, simply take the number 72 and divide it by your expected annual interest rate percentage. For example, an investment generating a steady 8% annual return will take exactly 9 years to double in value, since 72 divided by 8 equals 9. Try it out with your own average return rate, and let me know your doubling time. Trading financial assets using leverage can amplify your gains, but it exposes you to an automated broker execution threshold. What is a margin call, and how does it forcefully terminate a trader's position? Category: Banking. A margin call occurs when a trader utilizes borrowed funds from a broker to trade, and the value of their margin account drops below a required maintenance threshold. When this boundary is breached, the broker issues an immediate demand for the trader to deposit additional cash or collateral to cover potential losses. If the trader fails to meet the request promptly, the broker has the legal right to forcefully liquidate their open market positions without consent to recoup the debt. Follow Educo Global to master professional risk management principles. A stock offering a massive 12% dividend yield might look attractive, but its sustainable future relies on a specific corporate percentage. What is the dividend payout ratio, and how do you evaluate its safety threshold? Category: Investing. The dividend payout ratio calculates the exact percentage of a company's total net profit that is paid out directly to shareholders as dividends. The formula is simple: dividends per share divided by earnings per share. A payout ratio between 30% and 60% is generally considered healthy and sustainable, leaving the company with ample cash to reinvest in future growth. Check your favorite dividend stock's payout ratio before its next earnings call. Converting global currencies purely by standard market exchange rates fails to reflect what money can actually buy locally. What is purchasing power parity and how does it adjust global economic measurements? Category: Macro. Purchasing power parity, or PPP, is an economic theory used to compare the real purchasing power of different currencies across countries. It calculates an adjusted exchange rate based on the cost of a standardized basket of identical goods and services worldwide. This metric allows economists to compare gross domestic products and real living standards accurately, removing market rate distortions. Subscribe to Educo Global for daily international market analysis. Receiving $10,000 today is objectively more valuable than receiving that exact same sum 5 years from now. What is the time value of money, and why is it a core principle of financial planning? Category: Finance. The time value of money dictates that a specific sum of cash held today is worth more than the identical amount in the future. This core disparity exists because money held today can immediately be invested to earn interest, dividends, and compound returns over time. Additionally, future cash carries structural inflation risks that steadily erode its real purchasing power over the intervening years. Save this video to remember the fundamental law of wealth building. Investors who prioritize extreme corporate stability over rapid tech growth usually anchor their portfolios here. What are blue-chip stocks, and what primary characteristics define them? Category: Markets. Blue-chip stocks are shares of massive, nationally recognized, and financially stable corporations with a multi-decade track record of reliable earnings. These companies typically operate as industry leaders, possess highly resilient balance sheets, and consistently pay dividends through economic recessions. While they rarely deliver explosive overnight stock price rallies, They offer defensive protection and reliable long-term capital preservation. Name your favorite blue-chip stock in the comments below. Commercial banks adjust their lending fees based on a uniform baseline rate that is reserved for their safest corporate clients. What is the prime rate and how does it anchor consumer loan structures? Category: Banking. The prime rate is the benchmark interest rate that commercial banking firms charge their most creditworthy corporate borrowers for short-term loans. It is directly determined by a nation's central bank policy. In the U.S., it is structurally set at exactly 3 percentage points above the federal funds rate. This benchmark serves as the mathematical starting point for calculating consumer interest rates on variable credit cards, home equity lines, and personal loans. Follow Educo Global to master how interest rates dictate your daily expenses. Maximizing long-term investment returns depends less on picking the single best stock and more on a structural portfolio formula. What is asset allocation and how does it determine a portfolio's risk profile? Category: Investing. Asset allocation is the investment strategy of distributing capital across differing asset classes, primarily equities, fixed income, real estate, and cash. The exact ratio is determined by an investor's specific time horizon, financial objectives, and personal psychological risk tolerance. Equities drive long-term capital growth, fixed income provides steady defensive cash flow, and cash preserves immediate portfolio liquidity. Save this video to optimize your personal investment portfolio structure. Central banks print billions of dollars in fiat currency daily, yet they spend millions securing tons of heavy gold bars underground. Why do global governments maintain massive sovereign gold reserves? Category: Macro. Gold serves as the ultimate historical store of value and financial insurance policy against severe currency hyperinflation. Unlike digital fiat currencies, physical gold cannot be created out of thin air by political policy or central bank adjustments. It offers deep balance sheet stability and acts as an uncorrelated safe haven asset during global geopolitical conflicts or systemic banking failures. Subscribe to Educo Global for a deeper understanding of global macroeconomics. A company can capture massive media headlines by reporting billions in total sales while quietly approaching corporate bankruptcy. What is the critical distinction between corporate revenue and net income? Category: Finance. Revenue represents the absolute top line of an income statement, the total money brought into a business from sales before any deductions. Net income represents the absolute bottom line, the actual profit remaining after subtracting all operational expenses, debts, taxes, and interest costs. Extremely high revenue signals robust consumer demand, but it means nothing if operational overhead consumes every dollar brought in. Follow Educo Global to analyze stocks like a professional fund manager. Traditional digital agreements require banks, lawyers, and escrows to guarantee trust. Blockchain technology eliminates them entirely. What is a smart contract and how does it automate global transactions? Category: Markets. A smart contract is a self-executing digital agreement with the precise terms of the contract written directly into open-source computer code. It operates autonomously on a decentralized blockchain network, meaning it executes automatically once preset conditions are verified. By removing human intermediaries, smart contracts drastically minimize transaction fees, prevent human tampering, and speed up execution times. Save this short to stay ahead of future technology and financial trends. Economists do not track cash by counting physical paper bills. They categorize total liquidity into distinct monetary layers. What is the difference between M1 and M2 money supply metrics? Category: Banking. M1 money supply includes the most liquid financial assets, physical paper currency, coins, and immediate checking account balances that can be spent instantly. M2 money supply includes all of M1 plus near money, less liquid assets like personal savings accounts, money market funds, and short-term certificates of deposit. M1 tracks cash actively circulating in everyday shopping transactions, while M2 reflects the total stored purchasing power within the entire banking system. Follow Educo Global for structural clarity on how global banking works. Global stock indices face wars, recessions, and devastating market crashes, yet their long-term charts always trend upward. What underlying mechanisms drive the perpetual long-term expansion of global equity markets? Category: Investing. Corporate innovation. Public companies constantly create new technology and efficiencies to maximize revenue and shareholder profitability. Population growth. More global consumers naturally increases collective aggregate demand for essential goods, energy, housing, and corporate services over time. Index survival architecture. Major stock indices automatically drop failing corporations and replace them with rising market leaders, ensuring only winners drive the benchmark. Hit that subscribe button to join Educo Global and master your financial future.